Tariff wars erupt when countries impose taxes on imported goods, often triggering retaliation. This disrupts global trade, raises consumer prices, and rattles financial markets. Yet, as the saying goes, every crisis is an opportunity. One way to explore these possibilities is through exchange-traded funds, ETFs. ETFs are funds traded on stock exchanges, tracking specific sectors or assets, allowing focus on particular market segments. During tariff wars, certain ETFs may stand out because they're linked to industries less affected by trade disputes or that might even benefit. Consider the Vanguard Utilities ETF, VPU, which focuses on utilities like electricity, water, and gas. These essential services are mostly domestic, so tariffs on imports don't impact them much. With steady demand, VPU could be a reliable option in uncertain times. Next, the Vanguard Consumer Staples ETF (VDC) tracks companies producing essentials, food, beverages, and household goods. These are often made locally and see consistent demand, making VDC a stable choice during trade tensions. Tariffs can also favor domestic manufacturing. The Industrial Select Sector Spider Fund (XLI) includes U.S. companies in manufacturing and construction. As imports become costlier, demand may shift to American-made goods, potentially boosting this sector. Healthcare is another resilient area. The Healthcare Select Sector Spider Fund (XLV) covers medical services, pharmaceuticals, and equipment needs that persist regardless of trade policies. Being largely domestic, it's less exposed to tariff disruptions. Smaller firms can also benefit. The iShares Russell 2000 ETF (IWM) focuses on small-cap U.S. stocks, which often have less international exposure than large multinationals, reducing their tariff vulnerability. Governments may counter tariff wars with infrastructure spending to stimulate the economy. The Global ex-US Infrastructure Development ETF PAVE targets construction and engineering firms which could gain from such initiatives. Lastly, gold often shines in uncertainty. The Spider Gold Shares (GLD) ETF tracks gold prices, which tend to rise when investors seek safety during tariff-induced volatility. If this piques your interest, research further and consider consulting a financial advisor to align with your goals. This isn't investment advice, just education on how tariff wars might shift opportunities in the market.